Yes, all that you heard from Wall Street is what we will discuss. But today is actually another day. The Asian markets did start with that kind of scare that US left behind on the table. But if we can pick intradays of Hang Seng or Korea, or Kospi, that is, you will start to see that while they started with steep cuts of about 1%, look at the recovery that you're seeing in Hang Seng. Yes, all of it is not retained, but the early morning dip has found some buyers, and you will see a similar chart pattern on the Nikkei, in the Kospi. There is some effort to buy the lows. So Asia probably fell yesterday, presaging the Wall Street falls. We cannot be very sure that we need to fall all over again in tow with the Dow. The important part for India is that this big growth scare has taken crude to $62. So if indeed the dip is bought, then there is a good chance of outperformance. The only thing is today we don't have bond and rupee trading. When bond markets are trading at a time when crude crashes like this, they provide an impetus to banking stocks. But today we don't have that trading. So you can only guess where the bond yields will be.
Okay. Hi, Lata. Morning. Hi, Anuj. Morning. And we saw a lot of the sell-off play out yesterday, as you pointed out. But JP Morgan put out a very interesting note where they said that they expect this growth slowdown to continue in 2019 as well. For the US economy, they're forecasting a growth of less than 2%. And it's not just because of a reduced stimulus, a fiscal and monetary stimulus, but also, the negative drag from the trade policy. So I guess that market is one part of the equation. But our own markets have outperformed, right? So the question we're asking is, will the Nifty face a resistance at that 200-day moving average, or will it sort of take it out, because there has been an outperformance that the market has seen? Anuj, morning. You get a sense that we will you've been talking about how this market is decoupled from the other emerging markets, but you get a sense that positivity could continue, or could we sort of move along toe the same line?
Morning, Sonia. I think the buy on dips thesis is intact. That's not broken. Yesterday also was a good day, like I was pointing out in closing bell. Now look, there's a decoupling, and within decoupling there's decoupling. I just pull out the internals. This month the Dow Jones is down 2.6%. Nasdaq, of course, is down 5.5%. FTSE is down 2.5%. So the developed markets are down. But what are the emerging markets done? MSCI emerging market is up 1.6%. MSCI Asia ex Japan is up 1.7%. And in that context, what has India done? MSCI India is up 5.8%. So what do I mean by decoupling within decoupling? A, emerging markets are outperforming the developed markets, which is a theme which started after that developed market premium reached an all-time high. And Indian market within that is outperforming emerging markets. And we are the most, inversely correlated market to crude oil. So ingredients are in place. If we don't have a rally today, that would be market's message that perhaps that rally that you had from, like we discussed, 10,000 to 10,800, at least that part is over, and now you will need some reaction. But, and that's why perhaps that big trade may have gone. The market may have priced that in completely from 10,000 to 10,800, and now you'll have to perhaps go with the, lower trade. But for today, the focus should entirely be on oil sensitives. That's something, of course, that we will discuss. The other thing which has gone in favor of the bulls is that the Bank Nifty has got its mojo back, which is really good thing for the bulls. Also, IT is underperforming. So this month, if you see, the Bank Nifty is up 3.8%, and IT index is actually down 4.4%. There's a 8% sort of a divergence between the Bank Nifty and IT index. And I think that should hold the markets in good state. A couple of other old economy stocks are doing well. Larger point is, if today you don't break yesterday's low convincingly and have a bit of a rally, then perhaps that whole rally is still intact. But if today you sort of break lows and then start to trade lower in the second half, then I think the market's message would be perhaps that entire exertion is over. But that is not my base case. My base case is that this is still a buy on dips market.
Also, the market made this move from 10,000 to 10,756, I think was the high, because we saw crude move from 86 to 66. And now there is a further impetus. It's moved towards 63. So, logically that there should be something in the tailwind to be able to break the 10,750 resistance, but we will have to wait and see. We'll have to wait and see that if the growth scare is not there in Asia, then crude also may not remain at 63. It may start climbing back towards 65. So we are really speaking about moving parts here.
All right. Well, for now, the SGX Nifty is indicating that it won't be such a bad start as what we've seen with the US markets. It's flat actually for the SGX Nifty at the moment. But let's take a look at what our wise experts have to say as we head into trade today. Mixo Das of JP Morgan says while tariffs on all US imports from China is still on the cards, the pace of disengagement appears to have slowed compared to market assumptions only a few weeks ago. He continues to see merit in positioning for a year-end rally on improving risk-reward on trade and supportive valuations.
Okay, here's Sonal with the world view.
Well, we saw global sell-off and the Dow, that fell by around 500 odd points. This is after we saw a decline of 395 points on Monday. The S&P also didn't do too well. It fell around 2 odd percent. And Dow and S&P have now turned negative for the year. The Nasdaq, that fell 1.7%. And the majority of the fall was led by the technology stocks. Now, actually, the FANG stocks, they are in the bear territory. And they're down more than 20% from their 52-week highs. So not looking so good as long as US markets are concerned. Going to the European markets, similar situation there. All the major indices, they closed in the red. The European markets, they were sharply lower. The DAX, that slipped around 1.6%. FTSE, that was down around 0.8 odd percent. And it was the technology and the financial stocks that led to the losses. The other stock that was in focus is Renault, that fell further after there were news that there is Nissan's chairman being arrested. Also, the European Union, that is expected to hold a summit to discuss the possible Brexit deal. The sterling also partially rebounded from the lows it hit versus the dollar. So that is something that we are looking out for. The Asian markets, they are also indicating some red. They have recovered from the lows of the day, but still not looking so good for now.
Okay. Thank you very much. Yes, at the moment, there is a paint of red across Asia following the Dow indices, following the Wall Street indices. But let's see whether they want to fall for a second day running. How deep is the growth scare? Those questions to Adrian Mowat, the EM equity strategist, and Paul Kitney, the chief equity strategist at Daiwa Capital Markets. Both join us now on the phone lines. Good morning, Paul as well as Adrian. Thank you very much for joining us. First to you, Paul. We were just, quoting numbers to show that the developed markets have underperformed in November, but we have seen outperformance green on EM markets, and more particularly a big outperformance coming from Asia, coming from India. You think this pattern can continue, Paul?
Yes, I do. So we've had a big overweight in India, within Asia, ex-Japan, all year, which has been driven by superior earnings growth. Earnings growth that's also non-correlated with the global trade cycle. To be sure, a valuation premium, but a valuation premium deserved, in our view, largely because of its non-correlation with trade and sort of issues surrounding that. Inflation is also remarkably contained and will also benefit from the weaker oil prices.
Okay, by the way, Hang Seng slipping again. Let's see how that pans out. Adrian, good morning. We have seen some signs of outperformance of emerging markets versus developed markets, and within that, India outperforming emerging markets. Your thoughts on the entire universe?
Yes, so I'm actually very encouraged by the way EM is trading, particularly Asian markets, with the types of clues that we're getting out of Wall Street. So I think this does make a lot of sense as you look into 2019. The EPS premium that the US enjoyed over emerging markets is going to contract. And I think it's reasonable to assume some EPS premium out of EM. If you can get a stabilization and maybe a recovery come middle of 2019 in the Chinese economy, that would be very helpful. Perhaps trade tensions could also ease a little bit, which would be helpful for the big export markets of Korea and Taiwan. And I think for India specifically, you've got a huge macro tailwind here with the decline in the oil price. When we were having conversations 6 weeks ago, the conversations were very much focused about the high oil price, the weakness in the rupee, and perhaps risks around inflation in India in 2019. The movement that's happened in the oil price, I think, is going to help the rupee and clearly is going to be very positive for Indian inflation next year. So it does make a lot of sense that India is the leading market in Asia because it's the one that's getting the biggest benefit from the decline in the oil price.
Okay, so we have a consensus view that India is going to perhaps outperform. Gentlemen, morning. Paul, I was going through your note where you do expect a sharp slowdown in the US economy in 2020 with the possibility of a recession as well as early as Q4 2020. If there is a second leg of a global downturn, do you think that could take emerging markets, including India, down with it? And would that make you a bit circumspect to add fresh money into markets like India?
Right, it's a great question. So let me quickly sort of outline the roadmap. We're sort of looking out to 2020. So very, very near term, we're seeing valuation compression in emerging markets down to sort of what we would sort of consider sort of trough valuation levels, which are around a bit over 5% below where we are now, particularly for those emerging markets directly affected by the trade war. We see risk-reward at those levels being somewhat better. We see over the near term the dollar continuing to be a little bit strong, driven by the strong trade, the trade rhetoric. But we think we're not far off a dollar peak, at least for the short term, which should provide a certain degree of improvement in debt servicing burden in the EM complex, leading to some form of relief rally into 2019. So during that time, I think there is a scope for outperformance of primarily those markets that have underperformed. So it's probably not going to be India that outperforms in that context during that rally. It's more likely to be China, Hong Kong, Korea. And then I see sort of that plateauing, but by that time we may actually have the fade in the US tax cuts starting to sort of kick in, so that growth slows down from the first 3 quarters of this year at 3.3%, the current quarter around 2.5%, most of 2019 less than 2.5%, but still being kept alive by the US tax cut effect. But then as that starts to slow towards the end of 2019, I think we'll see the focus return to the US budget deficit. This should undermine the US dollar further, and then provide some near-term or some tailwinds for emerging markets. So that emerging markets could potentially decouple from developed markets in the second half of 2019. However, during 2020, we see a much sharper decline in the global economy led by the US, with a chance of a recession by the end of 2020 or the beginning of 2021, in which case equities as an asset class, including emerging markets, will struggle.
Oh, okay. Let me continue what Paul is saying and ask Adrian about it. Adrian, this global growth scare that Paul is talking about, and probably an inevitable slowdown, do you think that's going to overwhelm positives like crude for India? And while we may outperform, it will still be falling markets, both EMs and India?
I don't. I think as I look at the global economy, you've got slow growth out of Japan and Europe. In Europe, you had some special effects around the auto industry in Germany. So Germany, technically in a recession, the last quarter it reported. I think you'll see slightly better growth out of Japan and Europe going into 2019. Within the EM world, I would also expect to see some pickup, with perhaps China being the most important data point to be looking at there. The slowdown in the US is simply that you don't have the fiscal impulse that was brought into place by the Trump tax cuts. I think that's something that's in everyone's forecast, so I don't see that really being a surprise for the market. When we look at the underlying economic data in the US, you've got a tight labor market, rising wages, so the consumer remains strong, and that's the dominant part of the US economy. My fear around recession would really only come into place if you began to see US inflation data forcing the Fed to tighten. I think that is a risk, but at the moment it looks like a contained risk. Obviously will be helped by the fact that the oil price has fallen, which will help headline CPI in the United States. So I'm more sanguine about this. I think markets are sort of giving you a message, particularly in Asia, which is buy on dips. I think something you were making as a point in the introduction. So the base case, actually, I think, is okay economies, but clearly not as stellar an economy as we had in the United States in the first half of this year.
Adrian, that's an interesting point. Since you do look at a lot of these Indian stocks and sectors, I just wanted your thoughts on the consumption basket in India, because that went through a brutal correction and is now showing signs of life once again. You reckon the valuation drawdown is now enough, and is it still a good space to now buy?
But before addressing valuations, I think we need to consider the delta that's going on here. What is changing? So what is changing is the oil prices come down, the pressure on the rupee is easing. So I think there will be a rotation from the export earning sectors towards domestic sectors. You made a point about the bank indices doing better in India. So I think financials, domestic names will do better in this environment as portfolio managers shift capital from exporters. Now, with regards to consumption, again, the delta there is positive. The risk to a decline in discretionary income in India as inflation rose into 2019 should diminish with this decline in the oil price, particularly if the rupee stabilizes. So I think there are some really good macro reasons why you'll get a rotation in that direction, rather than necessarily a rotation being driven by valuations.
Okay, then one final question to you, Paul. We got your overweights and underweights, but in 2019, what would your pecking order look like? Where would you put money first, and which market would you avoid entirely?
Right. So, I think so. In terms of, I just addressed the last part there. The markets which we've been heavily underweight during this phase of a very strong dollar have been sort of the twin deficit countries that have seen deteriorations in both their fiscal deficits and also their current account deficits. So, Philippines was our bottom-ranked market in the region for this year. That continues because we still think the BSP is significantly behind the curve. However, one underweight there, Indonesia, we do see as being, along with India, as being one of the key beneficiaries of falling oil prices. Also, sort of given the direct effect on the fiscal balance there, namely that there's an election next year, some promises that domestic gasoline prices would not be increased, while at the same time we had seen quite strong oil prices as putting pressure on the fiscal balance, and then we sort of had an overall continued deterioration in the twin deficits. That should reverse somewhat. We're still underweight there, but we're sort of watching the macro picture there improving. Also, where we think that the central bank is doing the right thing was positive real policy rates there, which is encouraging. But I think in terms of the way our map is sort of mapped out for next year, we think to qualify, we think that emerging markets will do okay in 2019. The first half will be probably led by the North Asian names that I mentioned, during some form of relief rally based on some form of ceasefire or detente on trade, Korea and China in particular within EM, but also Hong Kong. But then later in the year, I think the focus will then come back to the premium associated with growth. Now, I don't see the risk in the U.S. as being sort of a pricing one through the Fed. I actually see it as being risks actually on the growth side, and particular a potential sort of for a credit shock to kick off some form of growth problem. Maybe not in 2019, but in 2020, and there are some systemic risks there. Okay. But I think India will do actually quite well, particularly in the second half of next year.
Okay, well, Paul, in that case, just give us one near-term view. This growth scare that has taken off all that the Wall Street indices gained this year, and that continues right now in the Asian indices. This is a dip you would buy, or do you think this gale can continue for some more time?
I think it really depends on how quickly we get some form of resolution on trade. So when we look at the simulations on the impact of a trade war on GDP growth, these are usually sort of assumed 12 months imposition of tariffs. Now, the longer the tariffs are actually imposed, the greater is the challenge for growth. So for me, again, this is the real risk. If we get a resolution at G20 in a week or so's time, then there's scope for quite a significant rally. If it lingers on, beyond, let's say, Chinese New Year next year, then I think that the chances of there being a sustainable rally are fairly limited in global equities. Now, as I mentioned, there is a chance for EM to decouple because I think the dollar is towards the end of its rally. It may have potentially peaked now. I think it's unlikely, but possibly over the next few months, in which case we could see a decoupling. Now, so long as global growth is still okay, now the IMF is downgraded to around 3.4%. That's still pretty good. And U.S. growth next year should be a touch below 2.5, which is okay as the stimulus from the fiscal cuts in the tax cuts in the U.S. is still there. But that really drops out in 2020. So I think next year could be okay. We could have EM decoupling, but then following there, I think there are significant risks to growth.
All right, Paul and Adrian, thank you so much for taking the time out and speaking with us. So the consensus view is that things are not as bad as they seem. Both Paul and Adrian are optimistic on emerging markets, especially markets like India.